Welcome to the PI World webinar on Thursday, 23rd of April, and I'm your host, Tamsin Freeman. And today Leon Boros joins us. And for those that don't know Leon, he's a qualified chartered accountant from EY. He founded Equity Strategies, a boutique corporate finance firm, and today he's a full-time investor. And he's achieved a 18.5% return over the last 13 years, annualised return that is. So a very successful investor. Leon, thank you so much for joining us.
And thanks very much for having me.
It's a pleasure. So 2020 has been a pretty tough year for investors, and I think you've been looking at some research and comparing it to war times and other bear markets. What have you found?
I think I found that looking to the past, whilst being fascinating, doesn't provide that many lessons for how we should play the future. I think that the following slides, which look at various bear markets, are probably more useful in the way that they're able to show that the duration of bear markets, and also how many leg downs you get during a bear market, or potentially leg downs, the number that you get during a bear market. I think that's more illustrative, more useful than trying to use charts, which I'm no chartist, but to use charts as a guide to the future.
So I think you looked at the war years first. Shall we look at a slide?
That's right. Okay. Before we do that, maybe just touch on some wealth warnings. I'm doing this without charge, and for the benefits of really helping everybody discuss and debate and improve their understanding, and really to help educate investors. So there's no advice intended here. I do own quite a few of the stocks, certainly those that I discussed when I talked about my portfolio on slide 10, and a couple of the stocks that are listed on slides 18 and 19 that talk about recent placings. This looks at the First World War, and we can see here that at the outbreak, or from the outbreak of the First World War to the 9 months afterwards, there was a 32% decline. The market was actually closed for quite a number of months, although there was some trading happening outside of the market, and subsequently some work was done which established that the index actually probably dropped from around 71 into the low 40s, but actually on the official numbers, when it reopened again, it opened up at this low of 53, so it was a 32% decline. But really after that, things were pretty positive, and that's despite, during the World War I having a massive increase in government debt, which eventually led to high inflation. We saw this, the market being relatively strong. There was a pullback from the all-time high, which happened in around December 16. It fell back 40%, and then towards the end of that, we had the outbreak of the Spanish flu. Now, people have said that the flu actually started in the trenches in 1916, but it didn't really get going until the summer of 1918. And as you can see, markets were fairly robust at that point. They've already seen the end of the war, seen towards the end of the war, and people were looking to the future. And I suppose governments then weren't looking to so many people had lost their lives during World War I. I suspect people were hardened to that fact. And although measures were taken to try and spare lives, still 50 million people lost their lives worldwide during that flu, but the economies weren't shut down. And I think people were looking to the future, and equity markets did very well thereafter. And if we move on to the next slide, now this is the run up to the great crash of 29 and the years that followed. It's interesting to note that the market rose threefold up until 29, up until it peaked at 386. This is the Dow Jones Industrial that I'm talking about. And there was this sharp decline, as you can see, down to 195. But then there was this 52% bounce from that low. And we've had in some markets a similar bounce back. I mean, the Nasdaq dropped from around 9,700 to 6,700, a decline of 31% in recent weeks. Now back at 8,650, it's only down 11% from its peak. And I think that people anchor in on recent prices. And, there was a very strong period of stock market performance in the run up to 1929. People got used to those high prices. So when they saw a chance of being able to buy them at a lower price, they piled in, only to see 5 lower lows arise over the following 2 or 3 years as the Great Depression really took hold. And I suppose there are some parallels to today as we try and fathom out what is likely to happen to the economy as we slowly exit from lockdown around the world. And it may be that we see a similar trend as people come to terms with it. There is one big difference, and that is governments worldwide are more aware of the role that they can play in providing liquidity and to soften the impact. And you could say in a Darwinian way that 1929 and the depression that followed, at least dealt with the issues. The economy was able to restart again by 32, and things went on from there. And in some ways, post the financial crisis and maybe post-COVID, we've not really allowed the bad news to really be felt. And it'll be interesting to see if we eventually pay a price for that. But of course, there is indeed a political price for allowing things to crash in the way they happened in 29. I mean, we all know that the subsequent period saw the rise of fascism in Europe, and the economic dislocation that followed created situations that led to other very unattractive political outcomes. So maybe policymakers are doing the right thing in terms of trying to protect us with this massive explosion of liquidity. We're moving in here into World War II. If you actually look in 1938, when Chamberlain went to Munich, met Hitler, and came back with the Peace in Our Time Munich Agreement, the markets liked that. They loved it, and markets were very strong in that period. So although we now look back and think and know that that was a disastrous agreement, it bought us some time, but it seemed incredibly naive. At the time, markets liked it. They believed that it was going to provide peace in the future, and certainly markets carried on rising right the way through 38, although coming back down in 39 as the realities began to strike home with Hitler invading Czechoslovakia and during that time. So we've then got a 30% decline through to, this is from the outbreak of war through to when the war really got started. There was that early period where nothing much happened in terms of affecting people's lives, but certainly by the summer of 40, the market was down strongly. It bounced back a couple of times from that. It reached had a further decline back down to 92 by June 42, and this was soon after involvement of America in the war following Pearl Harbor. I should say that this is all Dow Jones information, so very much US orientated, and of course that may not have reflected what was happening fully in Europe. And then we had, in America at least, the massive rise from 42 onwards. If we turn to the next slide, we'll see that that war has generally been quite good for equities, particularly in small cap investing. The average of all wars is around 20.1%, and that's against, this is for small caps, against 11.6 for the period when this work was done between 1926 and 2013. So, war isn't necessarily a bad thing. It means a repurposing of the industrial effort. And I suppose in most cases, one would have thought logically markets would decline going into a war because they would be anticipated, but markets would begin to anticipate the end of a war and rise before the actual end. So we may be seeing that effect working through in these numbers.
Do you think COVID is like a war?
Well, it's an interesting one. I mean, clearly during war you lose a huge amount of productive capacity, and there is the opportunity post-war to rebuild. There is similarities, though, in the sense that government debt both during this crisis and during wars, tend to rise to incredibly high levels. Both in the First World War and the Second World War, that increase in government debt was associated with significant inflation, and we may well see that return in time. But clearly, one of the problems we've got here going forward is that capacity hasn't been necessarily taken out, although capex will have been deferred by many companies. The question is, can that capex be brought back on, given the fact that so many companies have had to borrow significant amounts of money to see their way through this crisis? I suspect that capex will be muted for quite a few years following the end of this crisis as companies try and repair their balance sheets. Let's move on to the next slide, and we'll talk about just a couple of more slides, the oil crisis in the 1970s. People have said that this has got this compares to the current crisis. This is US data. From peak to trough, the market declined 47% there. In the UK, the market fell by over 70%. It was much more savage. But even during the oil crisis on the Dow Jones, there was an 18% sort of dead cat bounce after the first initial leg down. And as you can see, there were at least another couple of legs down before it reached its bottom. So again, the useful kind of clues as to how markets deal with these things, and that we might be anticipating further trouble ahead as this COVID situation unravels. And if we move to the last of these charts, 20 years of boom and bust. I mean, talking about the age of uncertainty, anyone who got involved in investing in 1999 has really seen three big drawdowns in the market of quite savage proportion. The dot-com bubble, the decline of 50%, the global financial crisis, the decline of 58%. Now we're onto the S&P 500 index, I should add. And of course, we've seen a peak of 33% decline in that index during the current crisis, and similar declines in the UK market. But the FTSE 250, should be pointed out, actually declined 45% at its trough. Now, we had this bounce back in the case of the S&P 500. This data is a couple of days old now, but we have had a 20% or so bounce, and are sitting at 20% below the COVID peak. And as I said, the Nasdaq 100 is only 10% or 11% below its peak. So it would suggest that we've got off lightly thus far. And although I don't think the current situation has got anything that it doesn't bear much comparison to the dot-com bubble, it certainly has a comparison to the global financial crisis. It's just there that once governments around the world got their act together and it introduced TARP in the US and a similar scheme over here, we really could predict that things were going to improve from there on. The problem we've got is we know there's problems. We just don't know, because of the virus, the duration of this problem. And that adds a different dimension to what was seen during the global financial crisis. So in short, I've got no real predictions. I don't know myself where we're heading next. I've absolutely no idea. And if I did know, I'd be a lot better off than I am. So all I can say is that we should bear in mind that markets don't go down in one go. When they go down, they tend to go down in waves. And there's every reason to think that as we understand more about the impact of this crisis, there could be further legs down. That said, the other argument that could be put is that there is still quite a bit of economic activity taking place. There are firms that are still working and looking to get back to work. A couple of firms today announced plans to reopen facilities. And we've still got the government spending and government and people working for the state, largely still working, and people being supported with the furlough scheme. So there could be, we may well adapt to this in a manner that avoids significant long-term problems. But we're going to have to wait and see. Interesting. But does it matter anyway in the long run? If we turn to the next slide, we can see that despite the Great Depression and the crash in 1929, despite the Second World War, despite the Korean War, the Vietnam War, the oil crisis in the early 70s, the flash crash in 1987, the dot-com bubble in 1999, 2000, and then the financial crisis, investing in equities has been a great place to be. And all those problems early on, you can barely see on this graph. And in the long run, equities have delivered, this is a 90-year analysis, a 9.5% return per annum, and have outperformed bonds. I think only in 11 10-year rolling periods during that time did bonds actually outperform equities. So I'm still confident that equities will go on to deliver very good returns for investors, but we have to take a long-term view and try and ride out this current problem.
So I'm sure you're right, but it doesn't always feel like that when you've taken a large drawdown on your capital. Let's just get a sense of how
it's like being on the Titanic and hearing that there's going to be some lifeboats put out there and another ship's coming by to save us all.
Let's just get a sense of how we're all feeling. So I'm going to do a poll to ask everyone to give an estimate of their year-to-date investing performance. And we'll keep the stakes low, greater than 10% return, 0 to 10%, 0 to minus 10%, minus 10 to minus 20%, or greater than minus 20. And if you could fill in your votes now, that would be fantastic. So the results of the poll are 46% minus 10 to minus 20%, 29% 0 to minus 10%, 12% more than 20% loss, and 10% are 0 to 10%, and just 3% more than 10%. So Leon, I guess we presume that you're in the top there, and you've made a positive return for the year.
You're speaking to the wrong person. In fact, the 13% of people who are actually up this year, I think you should find out. Although you said it was confidential, but it's a shame because some of those people might be better to present than I, because they've done remarkably well. If you go on to the next slide, I'll tell you how I've done. And you were very kind to point out my long-term performance at the outset of 18.5% annualized returns. I should say that was to the end of December 2019. It won't be quite so clever now. My performance, I'm down just over 3% for the year. Unfortunately, the pain has been within my ISA. I've actually had a positive year in my SIP and in my other accounts. And that's just in terms of where various assets are sitting. I've got a lot of Bioventix, which is sitting a lot of it in my SIP, which I had planned to move over to my ISA when the price dropped, never got around to it. And I've got a lot of Arcontech, which is down 19% in my ISA and very little of it in my SIP. And also, I had a lot of cash in my SIP, which when we went into this crisis, which explains why I've been able to protect myself better there. In cash, probably about 40%. I was looking to do a drawdown, and I did a drawdown last year, but I didn't do a full drawdown, so I'd got prepared for that. So there was a bit of good fortune there. And then the spread bet, so the other accounts, which does include some spread bets, have benefited from some successful shorts on the likes of Into and NMC Health, which have helped. But what I wanted to do by showing this table is really to talk about each of these companies. These are my 6 largest investments overall across all different types of accounts, and just look to see what kind of characteristics they have, which might be useful to understand in terms of building up a robust portfolio, one that can withstand these sorts of crises. And company that I've often been associated with, Bioventix, there is 205 million market cap, trading on a PE of close to 30, a forward PE. I think people are looking, despite the fact that share dropped back to about £26, I think people are looking to that company and thinking, this is a company in all this uncertainty that we've got confidence that it will continue to trade profitably. As you know, it makes very high profit margins of around 78%, and earns a very large return on its tangible assets within the business, 59% return. What I've done on that right-hand column, cash to OPEX, is that I've looked at these companies and I've compared their cash to their operating expenses. So I've ignored cost of sales, which I'm assuming is a sort of variable or semi-variable cost, and just seen how many years worth of OPEX have these companies got, assuming that they did not generate a single penny of revenue in the intervening period. Now, clearly, that's an unrealistic assumption because all of these companies will continue to generate revenues. But you can see how financially robust these companies are. Bioventix have got sort of 4.3 years worth of operating expenses represented in the cash. Arcontech 2.5. I'll come on to talk about 4base Bio in a moment. But Nintendo, which is a very large a very large company, I should say, given the fact that the rest of them are relatively small. I mean, that's got a cash balance equivalent to around 25% of its market capitalization. And one of the great things about Japanese companies is how conservatively they're managed. And then we have Arcontech. I'll talk a little bit more about Arcontech. That's one that has suffered. I don't see any obvious reason for that, in the sense that it's providing the pipes through which financial data is traveling, and all markets are open, whether it be debt or equity markets, and their services are still in demand. So it seems to me strange that that other shares have been marked down less when some of them have been shut down completely, and we have no visibility on when they're likely to return to being able to operate. Best of the Best is an online, has become an online only business. This is the company that operates a competition, a spot the ball competition, where you can win a car. It started off in airports where the ticket prices were very high, and the cost of running those sites in airports was also high. For about a year now, the business has been solely online. The company's been successful in making the ticket prices much cheaper, as low as 20 or 30 pence, and rarely above £5. And the operating margins there are improving. They're now sort of closing in on 20%. They had a very good trading update only a month or so ago. I think people sitting at home with very little to do, wanting to entertain themselves, are likely to play the game. I've certainly played it a couple of times in the last few weeks without success, and it's for a bit of fun. And I think Best of the Best, whose management team I really like. They're really bright and have lots of integrity, and that's just a general theme of something I look for. I like what they do. There is some regulatory risk with Best of the Best, and there's always the risk of the betting duty being increased yet again. But you can see phenomenal high returns on its tangible assets. So this is a measure I use. I take the total assets, that's current assets plus fixed assets, and I strip out goodwill and acquired intangibles. But I do leave in the calculation any capitalized development costs, software, or if it's an R&D company, research and development. So generally, companies that have very high ROTA X's will be very high generators of free cash flow. Nintendo, I've owned this now for almost 9 years and have added to my position in recent years. This is a business that did very well with its Wii product 10, 15 years ago, had moved to a situation where about 30% of its customers were utilizing its latest products and buying and downloading software onto the latest handheld product. But in the case of Nintendo, their customers were quite slow to move to downloads. A lot of them were still buying software in shops. And one thing that's very clear is that all games companies have seen a massive increase during this crisis of people downloading their games. And I think that's a really positive development for all of them, because the cost of distribution when you're using retail stores as an outlet is very significant. Whereas if you can distribute direct to customer, then your gross margins are going to be significantly higher. I mean, the markets recognize that with Nintendo. It sort of, in yen terms, its share price was about 44,000 going into this year. It dropped to about 34,000 at the peak of the crisis, and has bounced back quite strongly. I think for gaming companies, a PE of 20 is actually very attractive. If you look at Team 17, they're on a PE of 45. Frontier Development, again, a lovely company, but incredibly high multiple. And I think with Nintendo, you're getting an incredibly conservatively run company, as we've discussed, with a great franchise, long liked by Nick Train. It's been in his portfolio for a very long time, and I think it's a pretty solid bet during these difficult times. And the other one to mention there, Way Education. A bit different to the others in the sense it's not really achieving much in the way of meaningful profit, although it's spending a lot of its on marketing. I've held this for a while, but I have built up this position during this current crisis because I can see the appeal of its online delivery of education appealing, and it's significantly cashed up. So there's no real risk to that business over the next 18 months. I should add on 4base Bio, this is a German listed company. It's listed on the Frankfurt Exchange. It's based in Cambridge and also in Madrid. It's got a market cap of around 79 million, but for reasons that I'll explain, it's got net cash of close to 106 million pounds, although some of that is held in escrow, as note 2 will points out. The other thing to add on that one is that they recently did a 10 million euro buyback, which I've not reflected in that cash position, and that's mainly because it's not yet been its market cap is still based upon and I got this data from Stockopedia, that market cap is still based upon the previous number of shares in issue, not the revised number of shares in issue. So I'm just trying to get a number for that. But I'll come on to explain a little bit more about that business in some of the ensuing slides.
So the ones that you've been buying more into are Way Education, and which other ones during this?
That's a good question. Actually, the only ones that I've bought into during this crisis are Nintendo and Way. I've got my positions on Bioventix and Arcontech too large, and liquidity on best of the best is quite difficult, although I understand from the conversation we had before we went live that it has been possible to pick up stock of late.
And for Base Bio, have you been buying that?
Yeah, I've been buying that. I started buying in January when I met management, and I was buying it at sort of current levels, really. And then that was one company I felt very comfortable in buying as the price fell off. So the price dropped down to €1.20 at one point, but I bought all the way down. So I've got a very decent sized position. I mean, it's my third largest position as we speak.
So talk us through a little bit on Arcontech and why you think it's safe in this time of volatility.
So maybe for those people who don't know very much about the company, I'll sort of give a bit of background. It provides the means through which data is delivered, or data infrastructure, for producers and consumers of real-time and non-real-time financial data. It provides server-side software solutions for receiving, processing, distributing market data internally and externally, e.g. to Bloomberg or Refinitiv, along with a desktop software solution to enable end users to receive, share, manipulate and publish prices such as currency rates, bond yields, stock prices, etc. Its key products include a multi-vendor contribution system, Accelerator, which is an Excel add-in, and a desktop white label platform for displaying financial data and real-time data caches. This is quite an interesting product because what it does is that it allows an investment bank to populate data directly onto a platform that looks similar to one of the big companies like Bloomberg and Refinitiv, but able to put together that platform at a fraction of the cost of going direct and getting it sort of packaged up, if you like, from one of the other operators. Most of the data you can negotiate with data providers to sort of put their data into your platform, and this white label, what I call it a white label platform, allows that data to be plugged in using Arcontech software. And there is one very large investment bank who are the main customer for this product. They are looking to end its relationship with one of the big players. It will still continue using Bloomberg, but maybe for some of its back office staff in particular, they're keen for them to have access to this data, but not pay the £24,000 a year or whatever it costs to have a fully functioning terminal. So that's an interesting and exciting project to look at. Clients include main regulatory institutions, global tier 1 banks, So we've got JP Morgan, Barclays, Citi, and Morgan Stanley have been cited as customers.
And how do they get a toe in the door with these large banks?
Well, it is a slow sales process. It does take a long time. You can imagine they're having to sit down with the IT departments of these companies. Sometimes those IT departments have vested interest in trying to internalize and do everything themselves. And when they do persuade, they may persuade people on in one department, maybe on the trading side, but then they'll run into problems with the IT people who want to sort of protect it or want to try and build something themselves to achieve the same functionality. So the sale process it takes a while. They have recently employed 2 additional salespeople, but unfortunately, I think their starting dates coincided with the lockdown being announced, so they're going to be slow to start to get up and running. But I think the benefit of having those hurdles, if you like, to get new contracts is that contracts are rarely let go without a great deal of thought and consideration. So customers are generally pretty sticky, and the company is aware of problems significantly ahead of time if they are likely to lose a customer because the customer decides to do something differently. This just shows its recent share price performance. It peaked at just over 225. It's been down as low as 110. I did actually buy some at 110. And I started buying into this in the 70s. And the company's done very well. It generates very high operating margins of around 30%. And it's very operationally geared. So effectively, as new clients come in, more money drops through to the bottom line. And that's what I've seen. I mean, growth in terms of top line growth has only been sort of 8 to 12% in each half. But bottom line growth has been as high as 40 and 50%. And if we go on to the next slide, which really looks at the bull and bear arguments for Arcontech, as I've said, it's got significant operational leverage, and we've already seen that it has a strong balance sheet able to fund significant OPEX over a long period. And we've touched on how cash generative it is. The CEO, this was a business that wasn't doing well, it was losing money. He got involved in 2013, led the turnaround. He's my kind of CEO. He doesn't like to overpromise, and he is diligent, intelligent, and hardworking, and is conservative in his approach to managing the company. As I've said, its products are well entrenched with clients, and that has a strong product suite. And the hope is that Accelerator and the desktop, which are very linked together, that those products grow strongly as one of its key clients looks to accelerate its plans to replace one of its existing data platform providers. As I mentioned, the sales team has been enhanced, and I think the model is robust during this type of crisis. There's absolutely no reason that customers are going to stop using its product. There's always the possibility that some large investment bank clients might decide to play clever and delay payment, but most of the payments are made in advance anyway, annually in advance. So, if they're not going to renew, then and pay, then they won't get the service. There are some bear issues. As I said, it's a long and complex sales cycle. Until recently, they've had a limited sales resource that very reliant on their top 4 customers. Something like 60% of revenues come from those. And growth is very much dependent on a client's ability to implement its strategy. So this bank that's looking to introduce desktops, we're very much linked to its ability to do that and to implement it, and the pace of which it's implemented within the company. When I said recent NED sales, that was when I first used this slide, which was last May. So that happened in the first quarter of 2019. And as I've said, the COVID-19 crisis will definitely slow the sales pipeline. So that's one bearish point to take into account.
Interesting. Now, I'm very keen to get onto Forbase Bio, which I know nothing about. And
well, I don't know much more, really, Tamsin, or only a little more, because its business is DNA genomics, and I am by no means an expert in that area. I got to know about this company because they did a deal where they sold their proteomics and immunology businesses, which took the form of a business called Expedian. In fact, that used to be the name of 4base Bio, Innova Bioscience and TGR Bioscience, to Abcam for 120 million euros in January of this year. And as I've pointed out, 14.4 million of that in euro terms is being held in escrow. These businesses had been acquired by 4base Bio over a 2-year period, I think, at a cost of 40 million euros. So it's not bad, a 3 times multiple in a very short period. The group generated approximately 13 million in revenues and 1 million in EBITDA in 18, and they were guiding for 19 that they were going to enjoy double-digit revenue growth and EBITDA of 2.5 to 3 million euros. Now, I don't know what proportion of that EBITDA was in the businesses sold to Abcam, but it struck me as that Abcam had paid a very full price for this business. So I did, when I saw this news, I sold my shares in Abcam, and I thought I must make it my business to find out more about Expedian, as it was then called, but now renamed to 4base Bio. And the businesses that were sold included a leading protein, I'm not going to say that next word, technology and products with well-known industry brands such as Lightning Links and Capshaw TM. In fact, the TM should probably be in small letters, shouldn't it? That's trademark. 4base Bio retained its DNA, and this is the important point. In addition to having all this cash, which is not being valued properly by the market, 4base Bio retained its DNA genomics business, which, as I've said already, is based in Cambridge and in Madrid, and its proprietary True Prime technology. The business they're continuing with is expected to generate negative free cash flows of around 2 million euros a year. And the company's plan is to really focus on DNA manufacturing and establishing a GMP certified facility to supply DNA products for research, for therapeutic and other uses requiring large amounts of high purity DNA, such as the fast-growing market for novel gene therapies and gene vaccines. And unlike conventional therapies, where small molecules and proteins and antibodies are the typical active ingredient, DNA delivers the cure in gene therapies. And it's expected that the FDA will be approving between 10 and 20 gene therapies a year by 2024. Only 13 have been approved to date. So you've got to buy in to the idea that gene therapy is going to be a big thing. And I think I do. The question is, of course, when will it be a big thing? And that's one of the uncertainties with this investment. If we go on to the next page, I've got a bit more detail about 4base Bio. I should add, it's very easy to buy. If you're a Hargreaves Lansdowne customer, it's on their system. I don't know about the other platforms. So the plan is to use approximately a third of the proceeds to grow the business and on a buy and build strategy to enhance its genomic offering. And the company will use its IP to try and drive down the cost of DNA manufacture, and will consider the acquisition of a non-viral vector-based DNA delivery platform. So you've got to manufacture the DNA, which is needed in large quantities for therapeutics, but then you've got to deliver the DNA into the cell, and you've got to have a platform, a mechanism to do that. So far, the company's used around, as I've mentioned, 10 million euros to do a share buyback of about 10% of the share capital. And the way to view this stock is really it's a picks and shovels player in the DNA market, manufacturing it for both research, whether both preclinical and clinical, and for therapeutic markets. So we're not having to take any big bets here on which gene therapy to back. Finding the right genes for a therapy is a huge enterprise on its own and involves significant risks, and there will be lots of other companies out there doing that, and then going through the whole process of the trials and then getting it approved by the FDA is incredibly costly and time consuming. We're not involved in that. We're involved in not making those kinds of bets, but the single bet that DNA therapeutics will be bigger in the future than it is today. That's the only bet we're making here, and whether 4base Bio can become a significant player in the delivery of bulk DNA. Its annual results, by coincidence, are being announced tomorrow, They won't be so relevant now because most of that business has been sold, but I'm sure there'll be a lot of discussion about the future. And in fact, there's also an investor call. I have been given the link to that, but I think the best thing for people who are interested is to look up the stock. And when they announce their results tomorrow morning, there will be a link to that to the investor call. And I'd encourage anyone who's interested to take a listen. I'm sure you're going to be impressed, and we're all going to find out more about the next bullet point. It was an announcement made yesterday that 4Base Bio is going to be supplying enzymes and technical support to develop a faster and more sensitive test for SARS-CoV-2 infection.
So has that sent the share price right up in the sky?
Well, it seems to work for every other COVID-related stock. A bit like, the fact that during the dot-com bubble, every company changed its name to include the word .com in it, or internet. So it hasn't had. There's been a very modest rise this morning on that news, and it'd be interesting to learn more about how that's going to work.
And
as I said, to come to this,
it may consider a listing on AIM.
That's when I had a chat with this CEO. He had said that they'd considered it in the past. I mean, one of the problems the company has is that it's the CEO he's from Belgium. He lives in the UK in Cambridge, where I think he went to university, and he's married to a British lady. They're listed on the Frankfurt stock market. There was a reverse takeover of the company that the CEO founded in 2015 or 16, and that's why they're in Frankfurt. But inevitably, the company people aren't really very much aware of it and the story behind it. And I think it would be a great thing if they could move to the London market. I think it would really help with the story and people understanding what it's doing. And, markets are fairly efficient. So where you see a situation where a company is trading at a significant discount to its cash, and when I was buying at €1.20, an even bigger discount to its cash, you've got to ask yourself, well, am I missing something, which I may be, or it's just the fact that this stock really is under the radar. This is just worth pointing out where its share price has been, and you can see there was a big jump after the Abcan deal, and then a big pullback in March, which has partly retraced as of now. And if we go on to the bull and bear points. So the bull points are that the current valuation is at a 25% discount to cash and restricted cash balances. Investors are effectively getting the existing DNA business and the IP associated with it for free of charge. The CEO is highly intelligent, and he's got a proven track record, and he has really valuable insights into the industry. I think that he was able to see that if he brought together a combination of businesses, that it would appeal to a deep-pocketed corporate acquirer. And he's done that trick once. I'm betting that he'll be able to do it again. I mean, he set up the original business, when he was only 26 years old, I believe. And he's had to learn the hard way, building up a new start into what it is. So I think he's learned the hard way, but he has developed really strong commercial skills. It's got a very strong balance sheet, able to support the ongoing modest losses from the business that's continuing, to fund share buybacks, as we've seen, and also dividends and acquisitions. DNA manufacturing and DNA delivery platforms are less risky, as I've said, than developing a gene therapy. The sector is expected to grow significantly. And there is also a significant shareholder in the form of Mr. Zowers, a very wealthy German, I believe, billionaire. I might be wrong on the German point, but a very wealthy individual who's bought his shares through three separate, some in his own name and two through vehicles that he controls. He now owns 21% of the equity. Very shrewd guy. He's increased his holdings significantly since November. I like to follow smart people, and it seems to me if he likes it, then I should be liking it. The bear points: DNA therapies are incredibly expensive at the moment, €500,000 to €700,000 per patient. The development of DNA therapeutics is problematic. It's costly and time-consuming, and as I've said, you've got to get past the FDA. this is a nascent opportunity, and it may not scale as I hope. The company may not be successful in exploiting its IP to drive the cost of manufacture down. I think that driving down the cost of DNA manufacture is absolutely going to be critical to the success of gene therapies, because health services are not going to be in a position to spend that kind of money on each patient, especially with the current crisis that we're currently going through. There is an existing competitor called Touchlight, potentially a year ahead. I understand it was valued at £500 million, but or euros, but has no revenues. I've not been able to verify that, but that's the sort of rumor I've heard. Other players could always enter the market if it proves attractive. Acquisitions may be difficult to find at the right price, but actually, it's a great time to be cashed up, because there's going to be a lot of biotech firms in the relevant industries here who need further funding, who are going to find that the doors are closed to them, and where Forbase Bio may be able to come along and pick up something either cheaply, or pick up something that they wouldn't have been able to previously because it would have been locked up. And of course, the company, as a negative point, may fail to contain its losses or scale its business, in which case this cash resource they've got might be eaten away. And I should say that the CEO, he's had great success with his first buy and build strategy. Of course, you're only as good as your last deal, and it may not work a second time around.
Yeah, it sounds interesting.
But certainly an interesting one.
Yeah. Let's move on to placings. I know that you've been dabbling a bit in recent placings, and I'd love to know your thinking behind that and how it's worked.
Okay. Well, my thinking was very much that, one of the problems that companies, the market has in valuing companies is whether they're going to survive this crisis. And it seems to me that those companies that have taken early action to strengthen their balance sheets, particularly where they've used equity to do so, have at least removed that risk, or may hopefully have removed that risk. And therefore, it struck me that would be a sort of relatively low risk way of sort of buying companies that I wouldn't ordinarily be keen on, but might be worth it for the benefit of some kind of trade. Now, there's been 51 placings since mid-March, raising close to 3 billion on the London market. I've just listed here those that raised more than 5 million, and I've ranked it by the biggest percentage growth since the placing was undertaken. Avacta, anyone who got in there has done incredibly well. They make a synthetic antibody called an Affimer, but they've announced a tie-up with another organization to get involved in some aspect of COVID, and that's led to a massive price increase. In fact, that deal was announced just a couple of days after the money was raised. So investors there have done incredibly well. Synergin, which again is another COVID-related stock, is trying to develop a vaccine for dealing with COPD, and believes that its vaccine is suitable for COVID, and they've announced against some acceleration in their plans, raised money. I got scaled back there massively. So although the percentage gain I've made there is very handsome, the actual amount in absolute terms is rather small. I didn't get involved in any of the other 5 or 6 that are mentioned here. I mean, the 2 points to bring out really from this slide. Firstly, the dilution effect has been significant, 21.8% on average for those 51 stocks, and that's based upon existing holdings. And I should add, there's 3 reasons why companies have raised money. Either they're a biotech and they're scared that they're going to run out, B, that they're heavily indebted, or C, that they've been very cash generative but paid out those profits in the form of dividends or share buybacks and just want to protect themselves, maybe because their business has been halted for a period of time. So, but nonetheless, you can see the impact of buying companies with weak balance sheets, that you get hammered when it comes to a raise. A lot of these raises were done at a discount to the market price, and certainly at a discount to the historic price. So you lose in 2 ways. You get dilution. You can't often participate in them. I've not been able to participate in most, and you get the dilution as well. But on average, 17% increase. If you strip out a factor, it's about a 12% increase overall from the placing price to now. And if we look at the next slide, that shows each of the 51 and shows the percentage increases. You can see that, if you were to draw a line, you would see that actually the gains are beginning to run out. Sorry, I should say on the left-hand side, Hotel Chocolat, that was the first one to have a raise, and loungers and Science and Sport and DFS announced raises last night and confirmed them this morning. So you can see the percentage gains since the placing price have declined as time has gone by. But on average, there's been a discount to the previous closing price. So the placing price typically has been done at a discount to the prevailing price of around 5.7%. But interestingly, the three that were announced yesterday or last night, DFS, Science and Sport, and lounges, have all been done at a premium to their previous closing price. So,
and why do you
think that?
Why do you think that would be?
Well, I suppose existing investors in those stocks are thinking, how can we get these valuations up? If I'm being cynical, and are receptive to the argument they should come in at a higher price. Some of these things take a few days to organize, and sometimes you just get the price drifting away. So that might explain it in one or two of those cases. I don't know, but it's certainly interesting to watch.
So when you're looking at companies and you're obviously paying a lot of attention to their debt, how are you valuing them and how are you making decisions?
Well, equities placings is one way that investors can lose out. But if you turn to the next slide, as you've indicated, debt can also play a very important role. So many listed companies have announced that they've taken preemptive action to improve liquidity by utilizing their existing debt facilities, or maybe negotiating new ones, or raising new debt through the issue of bonds or accessing the government loan schemes. I mean, in the UK, we've got the COVID corporate financing facility. Now, theoretically, any new debt must reduce the value attributable to equity on a pound for pound basis, assuming that the enterprise value, which is the debt value plus the equity, remains unchanged. And I think it's fair to say that valuation methodologies that use enterprise value to either EBITDA or to EBIT, I prefer EBIT, become much more important. The problem with PE ratios of heavily indebted companies is that often they appear incredibly low, and that's because interest costs are so much lower than they were historically, and the after-tax earnings are less impacted. So I've got an example here. It's the last slide. It looks at, in fact, penultimate slide, it looks at EasyJet. And on the left-hand side, it's a bit faint, but you can see that on the 2nd of Feb, it was trading at close to £14, and it had a market cap of 5.5 billion and an enterprise value of 5.8 billion. So there was a 300 million or so debt facility in there, which at that time, share price has fallen significantly. When I did the slide yesterday, it was at 586, which gave us a 2.42 billion market cap and an enterprise value of 2.7. Now, in reality, that enterprise value or that debt is no longer 300 million. So this data from Stockopedia is not reliable in that sense. So if we turn to the last slide, we'll see one way of, and it's the back of a fag pack approach really to thinking about companies that have raised significant or even indeed modest amounts of debt. So on the 2nd of Feb, we've got there the equity value at that time. And then I've taken the rest of the data, the cash, the euro bonds, the aircraft leases, that's as of the last date it reported, which was the 30th of September last year. And I've added that together to come up with an enterprise value of 5.8 billion. And that was when the share price was close to £14. And then I've created a pro forma version of that. And I've taken the market cap as of yesterday, 2.42 billion. And I've taken over, as you can see, the cash, the euro bond, and the aircraft leases that it had. Now, the cash obviously may have changed from that historic number, but we haven't got that piece of data, so we don't know it. And in its recent announcement that it made to the market a few days ago, it talked about the fact that it recently taken out 2 loans secured against aircraft for 400 billion, that it had accessed the government's COVID corporate finance facility for 600 billion, that it had maxed out on its revolving credit facility of $500 million, and that it was in discussions with a number of people about a sale and leaseback that could be raised between 400 and 550 billion. I've gone for the max figure in this example of 550. So that gives us a kind of pro forma debt of about 2.3 billion, which if one adds to the equity value gives us an enterprise value of around 4.8 billion at the moment, and that's off a share price of 584, 585. So what I've done is think about, well, what would this look like if the market was at some point in time, we don't know when, but at some point in time, prepared to give this company the same enterprise value that it had on the 2nd of February 2020. So you can see the enterprise value there is back up to 5.861. All the figures there are unchanged, except the one thing that can vary is the equity value, which there is $1 billion higher than I've got on the pro forma, in the pro forma column. And that suggests that a share price based upon that debt structure, a maximum share price, if we were up to wind the clock back and go for the enterprise value as at the 2nd of Feb, would be £8.42. So, a handsome 44% uplift. Now, EasyJet have been very, very open in the way it's discussed its affairs, and it's created 3 scenarios based upon a number of assumptions which are listed there about it being in lockdown, for being grounded effectively for 3 months, 6 months, and 9 months. The funding that it has in place is really focused at the 9-month option, where it will use around 3 billion of cash. If you think this is a company that only generated 400 to 500 million pounds profit a year historically, potentially needing to use 6 or 7 years worth of profits to see its way through for the next 9 months. So, what I've done in that bottom right-hand box is ask myself, well, I don't believe the industry is going to be back on its feet for a while. Even if the grounding is only 6 months, the dislocation in the business is going to last much longer, and they're going to be flying with half-empty planes. I think a lot of countries are going to have restrictions on people coming in for a long time. So, but let's take that sort of 3 billion worst case scenario and say, okay, a 6-month lockdown or grounding, and then problems thereafter might consume 3 billion of cash. And therefore, the 842 is a possibility. How many years is the market going to take to be willing to value this company as it used to? If it takes 1 year, the IRR is a phenomenal 43%. But if it's 4 years, it's 9.5%. And of course, this all assumes, and it's really my final point, that the market will be prepared to value this company on the same enterprise value it used to, because of course it will see this business as being considerably riskier than it was, and therefore it's likely, in my view, to apply a much lower multiple to the equity, and therefore we're very likely to have, it's going to be a long journey back to that kind of enterprise value. So I wouldn't be buying at the current price for that reason. But I think I did this because I thought it'd be a useful example to use when you're confronted with a statement in a company that you might be invested in that's having to max out on its RCF and access government schemes, etc., and pile in the debt to see it through this period. There is a cost to it, and us equity holders are the ones who have to pay for that cost.
Fascinating to see that working, because it's so easy to price anchor to previous share prices, and it makes it very stark there. Now we're going to open up to questions now. It's been an absolutely fantastic webinar, Leon. Thank you very much. We haven't got as much time as we'd like to. We've gone well over the hour, but we will open it up. So the first question is: you like to follow serial entrepreneurs. Is there a major risk if something untoward happens? Are you confident on their succession planning? And that's from Peter Orban.
Hi, Peter. That's a great question. And you're right. I do like CEOs who are entrepreneurial and who I admire and trust. And unfortunately, most of them seem to be around 60 years of age, which if you've seen the analysis of death rates of 60-year-olds and COVID, it's a bit worrying. Yeah, it is. It's a constant worry for me, and I think 3 or 4 of my top 10 positions are in companies that are led by impressive, intelligent, but people who are sort of looking forward to of an age when people would normally retire. I have to say, though, that in each case, I'm thinking of Bioventix, Spectra Systems, and Arcontech. The people there are passionate about what they do, and they like to carry on for the foreseeable future. But there's always a risk, and you always have to worry about succession.
And the next question is, which of your top 6 holdings are you least convinced of?
It's a very good question. I'd have to say Way Education. It's a good story. I like the management team. It says it could be profitable if it wants to, but it's spending a lot on marketing. I think the worry I've got there is that the average duration of a customer is, if I can remember correctly, 5 terms. So you have to spend a lot of money on marketing. And unlike a public school where you might do marketing and have people, 9, 10, 12 years, whatever, you're only getting them for those 5 terms. It is increasing, it's improving. And clearly Way Education, in the sense that they're providing services to local authorities, problem kids in local authorities, then inevitably the duration is going to be small. They're just going to make sure they get that balance right between the marketing effort and the duration, because you don't want to be spending lots of money on people who are going to be gone and not have a chance to earn sufficient money back. But it's a very operationally geared model, that they can benefit from increasing scale, and that balances, I think, out, because in some ways with a physical school it's much harder to get operational gearing. So yes, you may have a long vista of revenue, but to expand, you're having to build new classes, employ more teachers, buy new freeholds, etc. So it's a much more flexible model.
So the next question is from Vivek Sharma, and says that they note that the illiquidity is an issue on quite a few of those holdings. Is that something that concerns you? And how do you go about building sizable positions in such illiquid securities?
Well, the liquidity always worries me during a downturn, and although I'm showing a minus 3% at the moment, it was significantly worse than that, it was significantly worse, during the depths of the crash. I think it was down 23% at one point, and inevitably those small companies got hit, and there was no way that I could possibly think about selling them, because I had a large position and generally they were illiquid. But I think the key is, you shouldn't be buying those companies on margin. You've got to be comfortable you can hold them through an extended period of time. And I have invested in more liquid stocks. I've got Legal & General and some other stuff, but I've got to balance out the fact that I know nothing in truth about Legal & General. I don't know where the skeletons are buried, if there are any. They could make an announcement tomorrow and it would completely take me by surprise. These smaller companies I can get to know and understand. I can understand their balance sheets, their accounts. I can talk to management. And I in that, my view, that balances out the problems of having too much or having liquidity. How to build up a stake? You've got to be patient, do it gradually over time, and it helps having a full service broker sometimes to do that. You can always shift it to your low cost broker afterwards, which is what I do, but it is useful having someone like that.
And there's a question here: when you look back, which stock do you wish that you'd sold, or do you most regret? So I think you could answer what you should have sold or what you should have bought. Well,
the one I regret not buying is Microsoft, because I like the product. I like what it was doing with the Surface. I like what it was doing with its data centers. and I could see that had potential. I haven't really delved very much into US stocks, but that was very cheap a few years ago, and I saw the likes of Fundsmith buying into it, and I regret not buying that. In terms of regrets at the moment for selling stuff, I sold Games Workshop at £44, and they're now at 51. I like the company a great deal. I was surprised and a bit upset that they decided to close their internet offering. And I'm worried there that, if shops, social distancing is going to become the new norm for the next year, there's no way that they're going to have young people and other fans playing their games in store as they used to. And although people tell me that 80% of their business is in the painting of the models and not the playing of the game, I think that if you're not able to play long term, that must affect the hobby side of it. And that this would have been a great opportunity during this lockdown for people to have enjoyed the hobby and bought new models, etc., and painted them, and they've not been able to do so. But I've potentially made a mistake there. I bought it in the low 30s, saw it go up to 70. We'll have to wait and see whether I've made the right decision on that. I don't like selling good companies, and that is a good company.
One final question. Which fund managers do you rate highly and follow?
Well, I do benchmark myself against fund managers, because if I'm not doing a better job than them, then I probably shouldn't be wasting my time. And they have reasons, as I've often explained, why they can't perform as well as a private investor. The ones I admire, I admire Fundsmith. I was aware of Terry Smith long ago when he produced his a book, Accounting for Growth, and he followed his career and his very successful careers at Tullett Prebon and Colin Stewart. That's someone to admire, and his strategy isn't very much different in many ways from my own, although I'm dealing with smaller companies. I like Nick Train at Linsell Train. Again, I've followed them for a long time, picked up the Nintendo idea, almost a decade ago from them. I like Slater. I think Mark Slater is a very shrewd guy. I know the team there quite well, and I'm impressed with their insights. And again, over the long term, they've delivered very, very good returns. And the final fund manager I really like is Lion Trust, whose name's just completely Anthony Cross at Lion Trust, who developed a particular style of investing almost 20 years ago now, and it's had considerable success with that approach. They would be the four that I would regard most highly.
Great. We do have more questions, but I'm afraid we've run out of time. So, Leon, thanks very, very much for a great webinar. If you want an email notification of company meetings or webinars we're organising, there's a sign up for events box on the right-hand side of the homepage on PI World. There are two boxes. On the top, sign up for notifications of a new video. Second down, sign up for events. A different list, and there's no spam. Please do tell your investing friends about PI World and write comments or like our videos on Twitter and bulletin boards and YouTube. We like to go on providing these free webinars, and getting good speakers like Leon relies on the audience numbers we get. And thank you very much all for joining us. Thank you to Leon, and stay well. See you next week.